Quite clearly, as Craig says, the behaviour of business and consumers is affected by interest rates. But so far in the US and Australia, rate rises haven't had the fully desired effect. The chair of the US Federal Reserve, as you heard Craig James say, Jerome Powell, overnight said while rates are unlikely to rise, they're not likely to fall as quickly as expected. The noted Australian-American economist Paul Sheard was the former chief economist at Standard & Poor's Ratings, at Lehman Brothers and at Nomura. He's the author of the Wall Street Journal best-selling book, The Power of Money, and he joins me now. Paul, many thanks for your time. I just want to get your input on this because quite clearly you're getting a very different message out of the Federal Reserve now.
Yes, Ross, and great to be back with you on the program. Definitely, they've backed a little bit away in terms of their forward guidance. They're signalling about what they're going to, or how quickly they're going to get into the rate-cutting business. The message from Jay Powell yesterday was clearly they will need to see really convincing evidence that inflation is going to come down this last leg. It has come down a long way, but it's kind of moved sideways, particularly on the CPI. Less so on the PCE, which the Fed actually targets. But it's really the CPI that the man or woman in the street seems to follow, and that has tracked at a 3 handle a little bit sideways. So we're going to need to see a lot more evidence that inflation is well and truly coming down to that 2% level.
Can I go to that point that I made with Craig James and about governments continuing to spend, which is adding to inflation and showing no real desire to stop spending, because politically that would be unpopular, versus the need to actually take stimulus out of the economy if you are to get inflation down?
Yeah, it's a great point, Ross. There is a kind of mismatch in our macroeconomic policy framework, which is that both fiscal policy and monetary policy influence the economy, demand, and inflation. And yet we give pretty much the sole job to the central bank to use its tools to control inflation. And obviously, if fiscal policy is not being cooperative, is not being coordinated, that means that the central bank has a harder job and means that we'll have to keep policy tighter for longer. And so fiscal policy is an important ingredient here, but typically central banks and fiscal policy operate somewhat independently of one another.
And one thing also is that quite clearly governments, while they've got a lot of people who are employed, are making more money from PAYG taxpayers. Certainly here in Australia that's the case. And so why is it that post-COVID we haven't been able to find the number of workers that would naturally have had our unemployment rate rise as the interest rates have increased?
Another great point, Ross. I think the economy is still and policymakers are still operating in the shadow of the pandemic, and we haven't really kind of got back to a more stable long-term equilibrium yet. And one of the reason that we had this great inflation shock, in my view, was that policymakers really misread the supply side of the economy. The damage that the lockdowns and COVID did to labour supply in particular, which rippled through the economy in terms of disrupting supply chains as well. And labour markets have repaired quite a lot, but there's still, on balance, more of a labour shortage. And as we've seen interest rates hiked up right across the developed world in the last year and a half or so, unemployment rates have remained pretty low.
And that's where Australia has got a unique position. It can sort of populate its way out of its problem by basically bringing in more migrants, but very few countries in the world enjoy that advantage. But of course, that causes its own social dislocation.
Yeah, that's right. The Australian economy, is, I think, somewhat unique in terms of having the kind of immigration flow that it has, which, increases the supply potential in the economy, but in the immediate term also puts some demand burden on the economy, perhaps before the supply benefits come through.
OK, just one final one, and that is the first rate cut in the United States now. When is it?
Well, I think it's well into the second half of the year. Obviously, we've got an election in November, and that makes the Fed nervous. But of course, they'll swear on a stack of Bibles that they don't take into account the political cycle. But I don't see a rate cut coming. Freudian slip there. I don't see a rate cut coming really anytime soon. And I think that was the message from Jay Powell yesterday as well.
And certainly no rate rises. Politically, that wouldn't be smart, I kind of guess, at this stage. But also, even economically, it's not necessary, you think?
Well, it's not necessary at the moment, but I've always been pointing out to people that don't dismiss the possibility that if the economy remains very strong, that you do get rate hikes. And there's a bit of a debate in Australia, I know about that at the moment as well. But it would take a lot of evidence that inflation is remaining stubbornly high, Ross, to get the central banks to reverse course, because they've got their interest rates where they wanted them, and they'd really have to be able to admit again that they got it wrong in terms of what that level of tightening was needed to achieve their target. So a big burden, a big hurdle, but it could happen.
I'll tell you what, Paul Sheard, great to get your input on the program today. As always, many thanks for your time.
Thank you, Ross.